Our next guest says the consumer is the key to the market puzzle. Joining us now is Alex McGrath, NorthEnd and Private Wealth CIO. Alex, it's good to see you. So you say, Alex, I like this, that the market, you say, seems to be mirroring our national mood here. What do you mean by that, Alex?
We're coming off the back end of a pretty long inflation battle here with rates being at historic peaks. And, you look at the underlying macro data that we're staring at every day, and it's not exceptional, but it's not bad either. It's just kind of in this middling phase. And certainly a much better start to this week than we had last week. But how much of that was really like recession fears, or how much of that was really, we certainly favor that had a lot more to do with that jobs number coming the prior Friday, and then you had all these whispers coming out. Potentially a 50 basis point cut got whispered into a quarter basis point cut, and then you had some turmoil there throughout the week, and now we seem to be back on track. So we'll see where it goes, but we're just kind of in this middling spot where, growth isn't fantastic, but it's not bad. And, jobs numbers aren't horrific, but they're not great. We're just kind of in this middling situation here.
What's going to change that, Alex? What's the next? Is it going to be the Fed? Is it something else you're looking to?
I would love to say that it's going to be the Fed riding to the rescue, but we all know that any kind of cuts or any kind of actions the Fed's going to take is going to take time to work through. And I don't think you have to look much further than a lot of the numbers we've seen from the consumer discretionary companies, where they're slashing forecasts because the demand just isn't there like it has been. And that's not entirely surprising. I know we keep hearing, inflation's way down. And that, certainly from a year over year perspective, that is absolutely true. But the problem is there's 20 to 30% built up in there. That's still increasing on a month over month basis. And it's just, the consumers got to get tapped out at some point. And, I'm not saying that's like a death and destruction phase coming, but you are starting to see inklings of that. And, the Fed lowering rates will help that down the road. But I don't know that there's any super immediate fix that they can do from the Eccles building in DC.
So Alex, if that's your view of the Fed, the economy, the consumer, how does that sort of shape your view of the markets, Alex? How do you want to be positioned in the equity market?
Well, certainly we feel like the next couple of months here could be a bit rocky. That's, not death and destruction, but it's just more taking a, tactically defensive approach, going out and grabbing utilities, industrials, healthcare, real estate, consumer staples. Typically defensive positions like that are interest rate sensitive should be a good spot to sit in right now, just because with interest rates potentially going backwards, and those defensive positions should buoy a lot of those or that section of the equity market. And so that's kind of where we've started to shift some things. That doesn't mean we're wholesale abandoning the large tech growth trade, but it's just repositioning some of the edges to get a little bit more exposure into those more defensive positions.
Gotcha. Where in tech still makes sense to you here?
It's, certainly, or I would say to us, semiconductors are really the new industrial, in our opinion. Those are just pieces that go into everything, where you're looking. So that would be the number one spot, certainly the large cap social media companies. I don't really have a ton of thoughts there, but for us on the tech side, it's all about semiconductors.
What about for fixed income investors who are listening right now, Alex? What's your guidance?
Ooh, that's been an interesting conundrum for the last 2 years there. Certainly, when all of this started, floating rate looked great. The shorter end of the curve was fantastic because you were participating in all of those interest rate hikes along the way, getting upwards of 6% on basically market neutral money. As we start to look at rates coming backwards, it's probably time to start taking some duration there. We've started to do that a little bit, not going way out on the curve, maybe in that 1 to 5 range. And, so that's kind of where we're sitting on the fixed income side. But, floating rate's been great this whole time, but everybody that's sitting in those floating rate and money markets, it's probably time to start moving that duration play out a little bit. And again, I'm not saying play the 10 to 15 or 20 to 30 curve, but certainly starting to bump that out a little bit should pay some dividends for people.
And finally, Alex, I know you're watching the consumer real closely here. What are you going to be sort of focusing on metric-wise in order to figure out the health of the consumer going forward?
Certainly keeping an eye on retail sales. I know the last measure we got was fantastic on that front. So we'll kind of see what the next looks like, and as well as the revision. But it's really for us watching the consumer discretionary spending space and those consumer discretionary earnings report to try to get a good idea of what that looks like. And that will certainly, those are the number one things that we're looking at as it concerns the consumer going forward. Like, what does that spend look like? And how does that translate into the next couple of quarters? Because that ultimately will alter our asset allocations.
Alex, thanks a lot. Appreciate it.
No, thank you for having me, guys.